Why you should care about the stock market. Hey there, welcome to Wall Street for All, where we break down the stock market for everyday people. No jargon, no stress. Today we're starting with a simple question. Why should you even care about the stock market? Why the stock market matters. You might think the stock market is only for billionaires or Wall Street pros, but actually it affects your life every single day. The stock market and your job. If you or someone in your family works for a company, guess what? That company may be publicly traded. If the stock price goes up, the company might grow, hire more people, and even pay better. The stock market and retirement. Ever heard of a 401k? That's a retirement account, and it's directly tied to the stock market. If the market goes up, your retirement savings can grow too. The stock market and the economy. When the market is booming, it often reflects a strong economy, and when it crashes, well, things can get shaky. That's why knowing even the basics gives you power. So even if you've never bought a stock in your life, the market is already part of your story. Example. We talked about why the stock market actually matters in your everyday life. Today, let's answer the big question. What is a stock? And we're going to explain it with pizza. Let's go! Meet Emma. This is Emma. She owns a small pizza shop. Her pizza is so good people line up around the block. But now she wants to grow. Maybe open 2 more shops. Emma needs money to grow. To expand, she needs more money than she has in the bank. So instead of taking out a loan, she decides to sell part of her business. She creates shares. Emma divides her pizza shop into 100 equal parts, or shares. Think of them like pizza slices. Each one represents a piece of her business. You buy a slice. If you buy 1 share, you now own 1% of Emma's pizza shop. You're literally a part owner of the business. What happens next? If Emma's new shops do well, her business becomes more valuable. That means your 1 slice, your stock, becomes more valuable too. You might even get a share of the profits, called a dividend. That's all a stock really is, a tiny slice of a company. When you invest in a stock, you're investing in that company's future. Quick recap. Emma wants to grow. She sells shares, stock. Investors become part owners. Stock value goes up if the company does well. Simple, right? What is a company, and why does it sell stock? We're zooming out. What is a company? And why would it sell pieces of itself to people like you and me? What is a company? A company is just a group of people organized to create and sell something like food, software, or sneakers. Private versus public. Some companies are private, meaning a few people own them, maybe a family or a couple of partners. Others are public, meaning anyone can own a piece by buying stock. Why go public? Going public means opening up ownership to the public and getting access to way more money. What's an IPO? When a private company becomes public, it does something called an IPO, initial public offering. That's when shares are sold on the stock market for the first time. Why sell stock? Companies sell stock to raise money for big things, launching products, opening stores, or hiring top talent. You become a co-owner. When you buy stock, you're giving the company money. In return, you become a partial owner. If the company grows, so does your piece of it. So now you know, companies go public to raise money and grow fast. And stocks? That's your ticket in. Quick recap. Companies. Businesses that make stuff. Private. Few owners. Public. Anyone can own. IPO. First time selling stock. Selling stock. Raising money to grow. You're getting the hang of this. What is the stock market? We've talked about what stocks are, why companies sell them, and today we're answering a big one. What is the stock market? Let's make it super simple. With a trip to your local farmer's market. The farmer's market analogy. Imagine a big open-air market. Each stall is run by a different farmer, or in our case, a different company. Shoppers walk around buying produce, but in the stock market, instead of apples and tomatoes, they're buying shares. Booths. Companies. Each booth represents a company. You might have Apple in one corner, Nike in another, and Amazon across the way. Buyers, ones, investors. And the shoppers? They're the investors, people like you, me, and giant institutions, all buying or selling ownership in these businesses. Supply and demand. Prices change based on supply and demand. If tons of people want stock in a company, the price usually goes up. If no one's interested, the price may drop, but it's all digital. Now, here's the twist. Today, the stock market is all digital, no actual booths. You trade from your phone or computer using apps like Robinhood, Fidelity, or Schwab. Behind the scenes, the buying and selling happens on big exchanges like the New York Stock Exchange and Nasdaq, kind of like giant digital farmers markets. What is the stock market? So think of the stock market as a big, busy marketplace where companies offer slices of ownership, and investors decide what's worth buying. See? Not so mysterious after all. Where trading happens. We explored what the stock market is, like a giant digital farmers market full of companies and investors. But here's something people always ask. Where exactly does all this trading happen? Today, we're taking you to two key places, the NYSE and the Nasdaq. Where do stocks trade? Most stock trading in the U.S. happens through two major exchanges, the New York Stock Exchange and the Nasdaq, NYSE. The classic giant, the NYSE, or New York Stock Exchange, is the most iconic and oldest exchange. It started way back in 1792. Big-name companies like Coca-Cola, McDonald's, and Walmart are listed here. NYSE. What it's like. Believe it or not, some trading still happens face-to-face on the NYSE trading floor in New York City, but most of it is electronic now. Nasdaq, the digital powerhouse. The Nasdaq is a younger, all-digital exchange. No trading floor. Everything is handled through powerful computers. It's home to tech giants like Apple, Microsoft, Amazon, and Tesla. Key differences. NYSE. Older, physical trading floor, traditional companies. Nasdaq. Newer, fully electronic, tech-focused companies. Think of NYSE as the classic Wall Street symbol, and Nasdaq as the high-tech, fast-paced sibling. Address why it matters. As an investor, it doesn't change how you buy and sell stocks, but it's good to know where your favorite companies live. Whether it's the NYSE or the Nasdaq, these exchanges keep the market running smoothly, safely, and fairly. Quick recap. NYSE. Historic blue-chip companies. Nasdaq, KAIS, digital, tech-focused. Both are places where stocks are bought and sold. You've now got the lay of the land. Or should we say, the marketplace. Why do stock prices go up and down? You've probably seen those zigzag stock charts that go up, down, and all around like a roller coaster. But why does that happen? What makes stock prices rise and fall? Let's break it down. It all starts with supply and demand. Just like any market, prices in the stock market move based on supply and demand. If more people want to buy a stock than sell it, the price goes up. If more people want to sell than buy, the price goes down. Ticket analogy. Imagine a sold-out concert and you have a ticket. People really want it, so they offer to pay more. The price rises. Same idea with stocks. What influences demand? So what makes people want to buy or sell? A few big things. Company performance. Is the company making money? Are they growing? News and headlines. Good news? Higher demand. Bad news? People may sell. The economy. Interest rates, inflation, and jobs all play a part. Emotions. Yes, emotions. Fear and excitement move prices more than you'd think. The emotion roller coaster. Investors are human. When things look great, people buy. When there's fear, they sell. The market can swing wildly on emotion. Alone. Price doesn't always equal value. Here's something to remember. Just because a stock price goes up doesn't mean the company is suddenly worth more. Sometimes, prices are driven by hype, not facts. So stock prices change every second. But the core reason? It's what buyers and sellers are feeling and doing in that moment. Quick recap. Price moves, size, supply and demand. Driven by news, performance, emotions. Emotions can overpower logic. Price always value. The more you understand what moves the market, the smarter your decisions become. Different types of stocks, blue chip, growth, dividend, and more. So far, we've talked about what stocks are, where they trade, and why prices go up and down. But did you know not all stocks are the same? Today, we're breaking down the types of stocks, from slow and steady to high-growth rockets. Not all stocks are the same. Different stocks serve different goals. Some are safer, some are riskier, and some pay you cash along the way. Blue chip stocks. Blue chip stocks are like the all-stars of the stock world. These are large, well-established companies with a strong reputation. They've been around for decades and are known for being reliable, kind of like the safe choice in your portfolio. Big, stable companies often pay steady dividends, less risky, but not risk-free. Growth stocks. Growth stocks are focused on, you guessed it, growth. These companies reinvest their profits to grow as fast as possible. They usually don't pay dividends because they're using their cash to expand. Higher potential reward. Often more volatile. Great for long-term investors with a strong stomach. Dividend stocks. Dividend stocks pay you money just for owning them. It's like getting a thank you check every few months. Regular income. Popular with retirees or passive investors. Usually large, stable companies. Penny stocks. Penny stocks are very low-priced stocks, often under $5. They can grow fast, but they're also risky and unpredictable. Cheap to buy, but risky to hold. Often small or struggling companies. Approach with caution. Value stocks. Value stocks are seen as undervalued, meaning the market may be underestimating their true worth, may be temporarily underpriced. Long-term potential. Requires research and patience. So, blue chip, growth, dividend, penny, or value. Each type of stock plays a different role. Depending on your goals, you might mix and match. Quick recap. Blue chip, reliable giants. Growth, high speed, high risk. Dividend, pays you cash. Penny, cheap but risky. Value, potential deals. The key is understanding what you're buying and why. Stocks. We're answering a big question. Why do people buy stocks in the first place? Whether it's your neighbor, your boss, or even your grandma, they're likely invested in the stock market. But why? Reason number 1, 2. Build wealth over time. Grow your money. Historically, the stock market has gone up over the long run. That means if you invest and stay in for years, your money can grow along with the economy. Example: if you had invested $1,000 in the S&P 500 30 years ago, it could be worth over $10,000 today. Long-term mindset and key. Reason number 2. To earn income from dividends. Get paid while you wait. Some stocks pay you cash, called dividends, just for owning them. That's right. Without selling your stock, you can get quarterly payments. Many retirees rely on dividend stocks for regular income. Think of it like owning a rental house. but instead of rent, you earn dividend checks. Reason number 3. To own a piece of great companies. Be a part of big brands. When you buy stock, you actually own a piece of that company. You become a shareholder. That means when Apple, Amazon, or Starbucks does well, you benefit too. Example: imagine being part owner of the pizza shop down the street. Except now it's a global brand. Reason number 4. To beat inflation. Protect your buying power. Inflation means your money buys less over time. A burger that cost $1 in 1990 might cost $4 today. Investing in stocks helps your money grow faster than inflation, so you don't fall behind. Bonus: some do it for fun or challenge. Investing is the new gaming. For some people, investing is like a strategic game. They enjoy researching, predicting, and even competing with friends. Just remember, it's real money, not monopoly. So whether it's building wealth, earning dividends, or simply being part of something bigger, there are lots of good reasons to invest in the stock market. Quick recap: grow money long-term, earn passive income, own top companies, protect from inflation, even have a little fun. Most people combine a few of these reasons to shape their investing goals.